London/New York/Tokyo, Reuters. Rare disease specialist Shire said on Wednesday it was willing to recommend a sweetened $64 billion offer from Japan Euro trademark Takeda Pharmaceutical Co to shareholders, in what would be the biggest acquisition of a drug company this year. But shares in Takeda extended recent losses, tumbling 7% as investors fretted over its ability to buy a company twice its size, raising doubts about whether Shire shareholders will accept a bid that is 56% in new Takeda shares. The stock slide, 18% since the news of a possible bid broke, makes the cash and share deal less appealing to Shire shareholders, some of whom may be reluctant or unable to hold Takeda shares. While this offer represents a solid improvement over Takeda Euro trademark's third bid, 38% cash, we still wonder if it is enough to satisfy Shire shareholders, said Jefferies analyst David Steinberg. Shire shares rose only 1.5% to £39.90 in early London trade, well below Takeda Euro trademark's £49 offer, signalling skepticism about the deal getting done as Takeda Euro trademark's falling stock price erodes the Beta Euro trademark's $64 billion headline value. It is now 4 weeks since Takeda first revealed it was considering a bid, and the absence of firm interest from rivals means investors see only a low chance of an interloper emerging. The latest development, first reported by Reuters, comes after London-listed Shire rejected 4 previous offers from Takeda. The fifth offer is worth £49.01 per share, comprised of £27.26 per share in new Takeda shares and £21.75 per share in cash. That represents a 4.3% premium to Takeda Euro trademark's fourth proposal on April 20 and an 11.4% premium to its first approach on March 29. Shire, a member of Britannia Euro trademark's benchmark FTSE 100 stock index, said its board agreed to extend a Wednesday regulatory deadline to May 8 so Takeda can conduct more due diligence and firm up its bid. Shire added the deadline may be extended further if needed. Any deal is subject to the resolution of several issues, including completion of due diligence by Shire on Takeda, the Dublin-based company said. A deal would significantly boost Takeda Euro trademark's position in gastrointestinal disorders, neuroscience, and rare diseases, including a blockbuster hemophilia franchise. If successful, it would be the largest overseas acquisition by a Japanese company and propel Takeda, led by Frenchman Christophe Weber, into the top ranks of global drug makers. Weber, who became Takeda Euro trademark's first non-Japanese CEO in 2015, has said publicly it was looking for acquisitions to reduce its exposure to a mature Japanese pharmaceutical market. Financial stretch. The combined company would have its primary listing in Tokyo and also offer American depository receipts, a move that would give Shire investors an opportunity to cash out more easily. But the transaction would be a huge financial stretch, and Takeda investors have been skeptical about the merits of a Shire deal, given the size of the potential purchase and concerns that a large share issue will be needed to fund it. Moody's Euro trademark's said the deal would pile up debt and hit Takeda Euro trademark's credit ratings. ETH's huge acquisition bodes a spike in leverage that could result in a multi-notch downgrade, said analyst Yukiko Asanuma. Ambitious cost-cutting is also seen as necessary to make the deal pay, and the uncertainties facing an enlarged group would spell a big change in the investment case for holding Takeda. Takeda Euro trademark's shares have been valued for their stability and relatively high dividend, said Daiwa Securities analyst Kazuaki Hashigichi, adding this made them attractive even to investors without specialist knowledge of the drug sector. Takeda, now worth $33 billion by market value, had 466.5 billion yen, $4.3 billion, in cash and short-term investments as of end December. It said on Wednesday it intended to maintain its dividend policy and investment-grade credit rating following the deal. Deal-making has surged in the drug industry this year as large players look to improve their pipelines. A Takeda Shire transaction would be by far the biggest. Shire has long been seen as a likely takeover target. Botox maker Allergan plc said last week it was considering making a rival offer, only to scrap it hours later due to pushback from shareholders. Shire was also nearly bought by U.S. drug maker AbbVie Inc. in 2014, until U.S. tax rule changes caused the deal to fall apart. Shire traces its roots back to 1986, when it began as a seller of calcium supplements to treat osteoporosis, operating from an office above a shop in Hampshire, southern England. Since then, it has grown rapidly through acquisitions to generate revenues of about $15.2 billion last year. But it has been under pressure in the past 12 months due to greater competition from generic drugs and debt from its $32 billion acquisition of Baxalta in 2016, a widely criticized deal. It announced last week a sale of its oncology business to unlisted French drug maker Servier for $2.4 billion. $1 equals 0.7170 pounds. $1 equals 108.8200 yen.